there, traders and investors. Bennett Tyndall, tradinganalysis.com. It's Wednesday, May 12th, 2021, and this is your weekly public market update. So taking a look at this morning's CPI report, it did come in outside of analysts' expectations, kind of restoking the inflation fear among investors. If you take a look at the all items index, we did see an increase of 4.2%. This was the largest 12-month increase since a 4.9% reading that we had, or increase that we had back in September of 2008. You know, the bigger question still remains and is yet to be discovered. Is this move truly transitory in nature, such as Jay Powell suggests and the Fed leads us to believe, or is this a move that's going to be a more prolonged and sustainable trend, which will continue to impact high multiple growth stocks? If that's the case, then the Elliott wave interpretation specifically of the NASDAQ 100 and of the technology sector, so the S&P sector spider XLK chart, if that's the case and we are going to see a more prolonged move, then we need to consider the possibility that this is a major third wave top in tech. And if that's the case, we do have some work to do on the downside. We're going to explore the charts here in just a minute. I'm going to give you some key levels to be watching. So as it stands now, the majority of the inflation that we are seeing is on the supply side. So as we kind of come out of this COVID rut from the past year, things are going to continue to be very dynamic and changing. We see a very bifurcated market as it stands now. We're seeing a divergence of confluence between our Elliott wave interpretations, and that makes for a very challenging market environment. So let's start it off. Taking a quick peek at today's sector scoreboard, you do see the S&P was down 2.14%. The NASDAQ 100 was down 2.62%. Energy was actually positive, up just shy of 0.5%. And the SMH, which is the semiconductor ETF that we traditionally track, was down 4.12%. Looking at the weekly chart here of the NDX, kind of a scary looking proposition if this is in fact a major market top. Taking you back down to the daily chart, we are seeing a brief TTM squeeze begin to fire to the downside. We have exhausted shorter term moving average support, and I do think we're on our way at the very least back down to the daily 200 moving average. All right, so let's jump into it. Hey, just a heads up, if you don't follow us on Twitter, it's a great way to stay up to date with us between our Wednesday video updates and our Wednesday streams, or I should say our weekly video updates and our Wednesday stream. Looking at a chart I hid back on March 17th, we were looking at an Elliott wave pattern here in TLT that matched up with the 10-year yield. So essentially what we had was inverse correlation of our interpretations. We saw a move higher in yields, obviously lower in bonds, being inversely correlated. And what we had identified back on March 17th, and this chart has unfolded remarkably well, is a key zone of resistance for the 10-year between 171 and 175. Not only did we have upside fib resistance there, we had traditional channel and trendline resistance to be watching. We were expecting that to give us a move in the 10-year back down to 1.42 to 1.49%. And that's the area that we anticipated support to come into play for a reversal to the upside. If I get you off of this chart, I'll just take you to Saturday. So Saturday, May 8th. I updated this chart. I haven't updated it since the March 17th tweet that I put out here. So on the 18th, the 10-year yield topped at 1.75%. We moved down in A. We have an expanded B wave with a measured move. And then the C wave demonstrated equality to the A wave. We did fall a little bit short of downside fourth wave fib support, but that doesn't mean that the pattern is invalid. So essentially what I suggested was maybe this is perhaps the start of the move higher in wave 5, and this is something to be watching. With our members, we said, okay, what event this week could give us that the catalyst to suggest the 10-year yield was going to resume its upward trajectory, if you would. And of course, today we had the CPI data. So where this leaves the indexes is it's a big question mark. It's a big question mark. So let's first start it off with the S&P. We're looking at the S&P 500 back to the COVID low. You can see here the C of wave number 4. I see this as either just shy of completing this 5-wave rally from the COVID low, or if I'm wrong and we don't have one additional move back to the upside, perhaps this 5th wave just came to completion at a 61% relationship to 1 and 3 inside of intermediate 5. And we're now going to be faced with a drawn out correction in wave 2. Being that this would be a wave 2 position, could take you to a variety of retracement levels. So as we've been doing, let's get off of the daily and let's focus in on price action on the 195-minute half-day chart, and then we'll take you to the 1-hour chart. So here's the 5-wave rally from the March 5th low. Dropping you down to the 1-hour chart, you can see the yellow circle for context. What you have here is off of the March 4th low, a move up in 1, down in 2. March 27th, we came out with a video calling for a break to new highs. We got the move to a new high. Wave 3 completed at about 161% of the duration of wave 1. We moved down in A. Here's your false breakout in B. The false breakout in B did have a 3-wave subdivision. It had triangulation in the B wave, and then it had an impulsive C wave structure. From there, we have a move down in 1, up in 2, down in 3, up in 4. We're now into a clustering of fib support that's offered from multiple degrees of trend between 40.5 and 40.87 for the S&P 500. If we start to break south of that zone and we start challenging the 4K handle, wave count and validation comes in at 39.83. If the S&P trades south of 39.83 and closes a cash session outside of that invalidation, we will have no choice but to shift our focus towards the interpretation that says, hey, wave 5 just completed off the March COVID low. It's time to get risk off. Over to the NASDAQ 100. In the NASDAQ 100, we picked up on and identified this pattern for you guys in last week's video. And essentially what we had here was a move down into the March 5th low, which was a measured move 3-wave correction. Talk about spot on Fibonacci at work. We then have an impulsive trend in A, a 61% retracement in B, and then we have a 5-wave subdivision in C. You'll notice our B wave found resistance between equality, so back to the origin, which happens to be the previous all-time high in the NASDAQ, and we didn't quite get the external 127.2% external retracement. Now we have a move down in 1, up in 2. I see this as an additional 1, 2, and we're trading south towards 12.4 to 12.6 in the NDX. So this particular L8 wave interpretation would give us one final push towards a new high. If we start breaking in the S&P through our wave count and validation, then we're going to be referring to the interpretation of the NASDAQ, which says chances are that move came to completion. So down on the 1-month chart, from the September 2000 low in the NDX, we're counting this as a move up in cycle degree wave 1, 3-wave correction to the 78% retracement in cycle wave number 2. We then have a monster rally in wave number 3. In wave 3, you have a beautiful 5-wave subdivision, taking you off of the 1-month chart and down to the 1-week chart. There are a few things that Elliott wave teaches us in terms of Fibonacci relationships between the various segments of a motive impulse. One of the common 3rd wave fib targets that we utilize is a 261.8% projection of wave number 1 from the wave 2 low. Inside of a 5-wave trend, when you have an extended 3rd wave, so essentially your 3rd wave is the longest and you have a clear 5-wave subdivision, then more often than not, or I would say about 60% of the time, your fifth wave ends up demonstrating equality to wave 1 of the same degree. You'll notice equality of orange primary degree wave 5 compared to 1 is 15,975 in the NASDAQ. The higher degree, and I'll hide the orange trend so you can see there, the higher degrees, 2618, is at 15,316. So we're beginning to see a confluence of Fibonacci resistance targets in that vicinity. Taking you off the weekly back down to the daily, you'll notice this is identified and labeled, given the overlap between the corrective pullbacks, as an ending diagonal. And when you're trading an ending diagonal, your 1, 3, and 5 subdivisions are required to be 3 waves. So essentially, we could view this orange 1, 2, and move up here as a 3-wave trend, and we could entertain moving orange 5 here, which then moves the higher degree green 3 here. That then sets us up for a much larger correction here, potentially in that wave 4 position. Coincidentally enough, equality of wave 4 compared to 2, based on my theoretical completion here, would give you a move back to the previous 4th. That's a very nasty correction that I do think is on the horizon. This chart is a fantastic example of why you need to always be considering your investment horizon and your investment time frame. If you are in your mid-20s, should you be concerned about this wave 4? No. You need to be taking advantage of this wave 4. You need to be using it to average down in any positions and add to your exposure, in my opinion, in growth and tech stocks. If you are in retirement and needing the funds, then maybe this is a chart that you need to be considering. Okay, so zooming in again off the weekly down to the daily. This count will become active if we trade south of 12,208 in the NDX. It won't become confirmed, but it will become a very strong possibility. The flat that we're tracking as our preferred at this time will basically call for a move back down to this clustering. You can get a 1272 external retracement on your C versus B relationship, but that would be pretty significantly pretty well below the typical 4th wave targets. That would equate to about a 7.5% break south of fib support. So I wouldn't envision that, which is why if we break through the March 4th low, yeah, this pattern could still take you to that 1272, but it's going to start to become likely that this is the case. All right, so that's the NASDAQ 100. Over to the XLK, Technology Sector Spider ETF chart. From the 2002 low, just like the NASDAQ, cycle degree 1, down in 2. Green cycle degree wave 3. Remember the 261% 3V1 and the orange primary 5V1 that we looked at in the NASDAQ. Well, here in the XLK, we have that confluence as well. Here is your green 2618 3V1 and your orange 5V1. That's at 142.5. Taking you off the weekly down to the 195 half-day chart. Look what happened to price action when we met those two Fibonacci objectives. So in the XLK, we met that clustering and we rejected it. In the NASDAQ, we didn't get there. So looking at this chart, if we just draw a simple trend line through the October low, through the March low, we're starting to break through that. So this is certainly of concern. If we take a look at the RRG, the relative rotation graph analysis, this is software program Optima. This is a new form of analysis that we're beginning to incorporate in what we do here at TA. We utilize this alongside Elliott Wave. We've been taking the growth versus value rotation into consideration. Even just looking at this on the 1-month chart, you're starting to see value move from lagging to improving, attempting to establish a northeasterly heading, while we're seeing growth move in a more southwesterly direction, losing both relative strength and momentum. Looking at a overview of the S&P sectors. We currently, on the 1-month chart, are seeing a very interesting rotation at work. Materials just moved on the monthly from improving now into the leading quadrant. Discretionary, communications, and technology all have south to southwesterly headings. So we're seeing a rotation away from growth and into value. You can see industrials and financials also moving from lagging to improving. And this is on the 1-month chart. This is the 1-month RRG. Technology is really starting to come off there. On the weekly, we are trying to curl back, but still well contained in the lagging quadrant. What's interesting is if I take you back in time and I do a comparison between the move into the 2000.com bust and now, you're going to see some interesting and very similar relationships at work. On the left-hand side of your screen, you see the RRG of the monthly, and on the right-hand side of your screen, you see the RRG of the monthly with today's price action. Okay, so this was just as we were really rolling off the top back in 2000. You had in the leading quadrant tech and the NASDAQ. So we've got 7 bars there. Let me add 7. NASDAQ and tech were starting to roll over from leading into weakening. That's what we're seeing here. Simultaneously, we saw staples, utilities, financials, industrials start to move from lagging to improving. We're seeing that kind of similar trend taking shape here. So we need to be aware of this potential rotation. And you can see back in 2000, we had a clear divergence where staples, utilities, financials moved into the leading quadrant. Technology in the NASDAQ moved into the lagging quadrant. And then you finally ended up with several orbitals before the market determined what it really wanted to establish as its leaders. And now here we are. Here we are once again. So a lot to be determined. Keeping my eyes very closely on this chart here in the XLK. Let me wrap it up taking a look at the 10-year yield count. Taking a look at our count in the 10-year yield, we do anticipate a move up here towards 2%. And taking you off of the daily down to the 195-minute half-day chart, the 17th of March, we were looking for 175. Here's your 3-wave correction. We're all the way back to 1.7%. This calls for a move at the very least to 2%. Now let's say we do get a more sustainable and prolonged inflation trend, and we do have a confirmation of our bearish count here in the XLK. If that's the case, then we need to be aware of and considering the possibility that 10-year yields are going to move all the way back towards our 2018 level, where we have a massive clustering of confluence at around 3%. Not my preferred view, but it is a possibility that we need to be aware of, especially as we digest the current trend at work. So really quickly, let me take you back to the S&P and give you the key takeaway zones. Back to the S&P, looking at the possibility that this is simply just a wave 4 flat. We need to hold 40.5 to 40.87. From there, if we hold, we're going to look for one final move into the summer, and then we're going to be faced with a more drawn-out consolidation. Alternatively, if we break south of that and we challenge wave count and validation, we've got to consider the possibility that we're setting up now for that wave 2. Over to the NASDAQ 100. The NASDAQ 100, at the very least, in my opinion, and is heading back to 12, call it 12.5, 12.6. And if we break significantly below that, we have to consider the idea that this ending diagonal completed along with the XLK, and we are going to be in a multi-year correction in technology and growth stocks. That's it for me. I hope you enjoyed this very extended video. I'll see you guys on the next one. You can check us out anytime at tradinganalysis.com. Thank you so much. Appreciate taking the time out of your day. Also looking at our wave count in TLT just to show you the level of confluence that we have here between our 10-year yield count and TLT, obviously 10-year versus 20. On the left-hand side, we have our wave count in TLT. On the right-hand side, we have our wave count in the 10-year yield. So here is A, B. This is 1, 2. Here is 1, 2, 1, 2, 3, 4. Intermediate 1, 2, 1, 2, 3, 4. Here is your kind of confluence of inverted wave patterns. So we'll see where this takes us. I still remain constructive in the long term, even if we're going to be hammered in the short term. We see a post fourth wave breakout to new highs. That's it for me. Again, I hope you enjoyed the video. Check us out, tradinganalysis.com. Hope to see you guys every Wednesday, 8:45 Eastern on Todd Gordon's YouTube channel, and every Thursday, 9 a.m. Eastern on the Trading Analysis YouTube channel for Alex's live stream show. Thanks again for tuning in. We'll see you guys next week.